The Federal Reserve, in its efforts to curb inflation, is poised to persist with raising interest rates and shrinking its balance sheet. In this video, we're going to see what the Federal Reserve is doing with the quantitative tightening. I've updated till the month of November, and in this video, let's look at the December and January month details. During the pandemic in 2020, the Federal Reserve swiftly intervened to mitigate its economic impact by lowering its interest rate target close to zero and acquiring substantial amounts of U.S. Treasury bonds and mortgage-backed securities through infusing reserves into the banking system. These purchases caused the Fed's balance sheet to expand significantly, growing from approximately $4 trillion prior to the pandemic to around $9 trillion in early 2022, more than doubling its size. The Federal Reserve announced its quantitative tightening plan on May 4th, with Fed Chairman Jerome Powell declaring in one of the FOMC meetings that the tightening would escalate, resulting in a monthly removal of $95 billion starting in September. Let's examine the Fed's actions. Again, if you're here for the first time, you need to know these two terms. When the Fed prints money into our economic system, it's called quantitative easing. When the Fed removes money from the economy, it's called quantitative tightening. Information is published on a weekly basis, and I'm going to show you what the Fed did for the month of December and January. This data can be accessed publicly on the Federal Reserve's website, so take advantage of this valuable resource and act accordingly. So for the month of September, they removed $32.7 billion. For the month of October, they removed $113.7 billion. For the month of November, the Fed removed $112.8 billion. And during December, for the week of December 7th, the Fed removed $1.9 billion. During the week of December 14th, $1.3 billion. During the third week of December, the Fed removed $18.5 billion. And during the fourth week of December, the Fed removed $12.4 billion. So for the month of December, the Fed has removed a total of $34.1 billion. This is less compared to the month of October and November, where the Fed has removed more than $110 billion. Let's look at the month of January. During the first week of January, the Fed removed $43 billion. During the second week of January, the Fed removed $1.2 billion. During the third week of January, the Fed removed $20.3 billion. And the fourth week of January, the Fed removed $16.2 billion. So for the month of January, the Fed removed a total of $80.7 billion. So the Fed's ramping up the quantitative tightening. Along with the tightening, we all know that the Fed is raising interest rates. The Federal Reserve has been hiking interest rates at a rapid pace this year, surpassing the speed of the 1980s. This makes borrowing money costlier and is part of the Fed's plan to curb consumer and business demand and curb inflation. The Fed's all but certain to raise rates 0.25 percentage points when it announces interest rates at 2 p.m. Eastern Time on Wednesday, February 1st, according to interest rate futures. Following that, the March 22nd meeting should be a similar story, where the Fed's likely to once again raise rates 0.25 percentage points, though there's some chance the Fed holds rates steady. If these forecasts are accurate, it means that the main informational value from the Fed's next meeting will be insight into the Fed's plans for interest rates for the meetings of May, June, and beyond. Here, the market anticipates that the Fed will hold rates steady or even begin to cut them later in 2023. Still, many Fed policymakers continue to comment that rates are likely to rise over 5%. That's in contrast to what the market is expecting. The December CPI inflation report showed a 6.5% inflation rate, down from 7.1% in November. The inflation peak was 9.1% in June. Although inflation is still rising, it's slowing down. Year over year, energy prices increased 7.3%, services, excluding housing, 7.4%, shelters 7.5%, and food prices 10.4%. These categories are crucial to the Federal Reserve. A 10.4% inflation rate for food is challenging for everyday Americans, but has little impact on the wealthy as food's a smaller part of their budget. In December, the prices of fruits and vegetables rose 8.4%, milk 12.5%, coffee 14.3%, bread 15.9%, butter 31%, and eggs 59.9%. Energy prices increased 7.3%, but were partially offset by falling gas prices due to a recessionary environment. Historically, recessions reduce oil demand by 1 to 3%, but it's expected to rise by 1.3 million barrels per day in 2023. Services, excluding housing, rose 7.4%, which is a major concern for the Federal Reserve. The central bank's been worried about the overheating labor market and the shortage of workers leading to higher wage inflation. This category saw a 0.4% increase in December, which was not positive news for the Federal Reserve. The Federal Reserve intends to increase interest rate and maintain the higher rates for an extended duration, as indicated by Federal Reserve Bank presidents. I'll keep you updated on the upcoming FOMC meeting, and I'll make a detailed video on how the FOMC meeting implications on stock market and crypto market next week. Please subscribe. Thanks for watching. Until next time.